And so
Okay.
part of my mission is really just to sort of, I'm by background, I'm a GP, a mid-cap GP, mostly in Europe, Middle East and Africa. But I also involved as a consultant and also teach private equity. And so I thought it'd be very interesting to have a discussion with you based upon your deep expertise as an analyst in the sector, and try and bring it to life, for a wider audience, as it were. And so that's the plan today. So is that okay for you, Mitch, that we do that?
Yeah, that works for me. And hopefully with what I sent you, you have an idea of what I may be talking about. And I would say my expertise, certainly I've been in the private real estate side of things, but so many of the same issues you see in private real estate with return measurement, thinking of risk, things like that, are the exact same issues that you have in more general PE. So, and I think I'm pretty versed on the PE literature, and like I said, I can really connect with the same issues that they have in the more general PE market.
Okay, that's really interesting. So, okay, well, let's get into it. And so I think we've got four broad topics we're going to cover. So maybe we spend 10, 15 minutes on each. And so the four topics we're going to talk about is private equity fund performance. Then we're going to talk about fiduciary duty, which is something that's very interesting to talk about, which people don't talk about much. Assessment of risk, and then finally, I think the concept of persistence, which is interesting for someone like me, is if you're a top quartile manager, how likely are you going to repeat that? So maybe we can start with let's start with private equity funds performance, and I think the two kind of important themes running through some of your work is the idea of replicating the risk of a base fund by using a leverage, and then the question of using public market equivalents to assess private equity and other types of funds. So perhaps you could kick off and give us a little bit of your point of view on that, and maybe I'll chip in and make the odd comment or request the odd clarification.
Sure. Well, first of all, I would start out is in terms of performance measurement. As a modern fiduciary, it's not just about looking at nominal returns. You need to consider returns, but also the risk taken to get there. And then we look at PE in general, and the three biggest, most prominent metrics they use are IRR, return multiples, and vintage year percentiles.
And that's basically, and
have,
that's just the returns. That's not actually the risk, right? That's just measuring the returns, essentially. So that doesn't consider the risk
that's
at all.
exactly.
Yeah.
That's correct. So, and this is a question that, that I have is, can you be acting as a fiduciary if you're using metrics to measure performance that don't consider risk? And for me, the industry seems to think it's fine to do that. The way I would read the fiduciary laws, and I'm also a CFA charter holder, so you're held to that fiduciary standard. Maybe this is a disconnect in my brain. I don't see how you can be acting as a fiduciary when you use those metrics, because not only are you not considering risk, you're also not considering what the market had done. And in this case, maybe you consider like some sort of traded market indice. So for instance, if we go back and we say, 20 years to 2000, and we look at, okay, what's the EBITDA multiple that companies were being bought at? Something in the neighborhood of 7. Now it's around 11. So even if you had bought a company, had done nothing to it, changed its cash flow, its EBITDA at all, not at all, you're going to have a significant run up in the value of that company for things that were out of your control. So that's why you need to incorporate some sort of market benchmark to be able to adjust for the fact that there was a lot of things that happened that were completely out of your control.
Yes,
And
it's, I think, what
like I
Warren
said,
Warren Buffett referred to as the rising tide, right? When the tide withdraws, you see who's got pants on, I think.
well, and if you look at, I would say, consider it sort of a modern, let's go back to, 1960s CAPM. The whole point of that is you are comparing to a market, which itself is a moving target. And in addition, what the CAPM is intended to do is to adjust for the relative amount of systemic risk taken in comparison to that market. So exactly like you said, since the great financial crisis in the US, the equity markets have run up quite dramatically. But if you were running a fund and you ran up similarly dramatically, taking the same amount of risk, it's not because you've done something that's above average, you could have run up just being average. And if, for instance, someone chooses to pay some sort of performance fee over an 8% return, and over the last 8 or 9 years, you just bought a stock index and it returned 11 or 12%. You didn't create any economic value, but yet you would have gotten compensated for that return over 8. And that's really, I think, the disconnect that exists in private markets in general.
Yeah, and so I think part of the attempts to find a solution for that is the use of the public market equivalent. So perhaps you could just explain in simple terms, in your words, how the PME system works, which is, adopted by the industry, and what you see as its potential shortcomings and risks and glitches and idiosyncrasies, if you will.
Well, in my mind, the PME is a gigantic step forward, because essentially what it says is, of the cash flows invested into this private equity fund, if instead you had invested the cash flows into some sort of publicly traded market, how would the returns of that publicly traded market, how would that compared to the investment in the actual fund that's under evaluation? Now, you have several ways to do this. You can look at return multiples. You can look at, and there's numerous methodologies, direct alpha, modified PME. There's a good handful of them, and they all really get at the same sort of thing, which I think is a great step forward. Now, there's two challenges to it. The first is, how do you pick what you think is a reasonable market benchmark? So, for instance, if you're investing in, if you're evaluating a fund that is, would fit into a small cap index, if it were traded, it probably makes sense to compare to something that's small cap. Similarly, if you look at value versus growth, many of these PE funds are levered much higher than a traded equity market. So what they end up doing is end up buying PE funds are similar to
So is it like if the P fund is
value companies?
Yeah. So if the P fund is more levered than the index, average company in the index, it's like comparing an apple with an orange, and you have to make an adjustment. Is that would that be the approach?
Right. So it's reasonable. In my mind, it's more reasonable to compare it to an index of value funds. And the reason why value funds is because these more highly levered PE funds, they need to have higher cash flow to be able to service that larger debt service. So if you wanted to say, let's take a broad brush approach, and if you look at the sort of the 6 Fama and French market indices, in my mind, it would make the most sense to compare them to a small cap value index, just because that tends to fit the characteristics of most PE firms. And certainly people could, reasonable people can say, okay, well, maybe we want a little bit of, small cap, a little bit of mid cap, and, play around with that a little bit. But the general thinking is it's probably more reasonable to go with a small cap value index.
But wouldn't that challenge? But wouldn't that also depend on the type of company in your portfolio? Because if I'm like a big buyout fund and I have big companies, probably I'm going to use the S&P because my companies are comparable to the S&P or some like big company equivalent. But if I'm like a venture fund or a growth fund, I'd probably go for the small cap. So doesn't it also depend on the composition of your portfolio, what the right index should be, rather than the firm itself, if you see what I mean?
Yeah, well, and that's sort of the art to the science of this. So the science is, yes, it makes sense to compare to a market. The art is, what's a reasonable index? So for instance, if you're investing in an energy company, does it make sense to compare to, something that I'm familiar with, a publicly traded REIT index, or a technology firm, or other type firms like that? So there's certainly an art to it in trying to zero in on what makes the most sense. And there may not be one answer, but you could possibly say, hey, listen, here's what we would get if we compared it to all small cap value funds. Here's what we got if we compared it to an energy index or small cap energy. And then there's an issue with, how many firms that are compared to. So I would say there's not a right answer, but there's some answers that I would say reflect a little bit more thought put into it than others. And for an analyst, I would think it's probably reasonable to use a couple of different benchmarks. Now, that's the first issue you run into.
Just one question. I can't resist interjecting. It's quite topical because I remember the recent paper from Ludo Philippou, where he's basically claiming that there's a kind of selective use of indexes by some of these big buyout firms to make themselves go into a good light. What would you say to that? Do you think that's something, a practice that's quite common, that they selectively find an index that suits them to show a better performance?
Well, I mean, I would say that if you're running a firm, it's your job to market yourself. And if you have a choice of where you could, how you're going to measure your performance, of course, you're going to pick something that puts you in a better light. Now, it is up to the investor and the fiduciaries working on their behalf to then interpret that and say, does this make a lot of sense? Or and what I always like to say, if you're thinking about risk-adjusted returns and bifurcating returns into alpha and beta, the easiest way to generate a positive alpha is to undermeasure beta. So it's the investors need to make that judgment, because if you leave it up to the managers, they're of course it's in their best interest to make themselves look good. So it's up to the fiduciaries to be able to interpret that and be able to have the analytical ability to say, hey, listen, maybe the S&P 500 isn't the most reasonable benchmark. Maybe it's a small cap value index, or maybe it's a small cap firms in the energy industry, or whatever
Sure,
the case
yeah.
may be. So
And
but with
where do you, just to finish on the first topic, so where do you think the PME, where do you think it's going to go? How is it going to evolve in the future? You think it's going to become more and more robust over time, and the industry of using PME to benchmark is going to result in greater transparency going forwards across the asset class?
well, I would say, like I said, the other main challenge with PME, in addition to trying to figure out what subset or what index of firms are most reasonable, is how to adjust for risk. So for instance, if you use a PME analysis, the only way a PME would represent a risk-adjusted performance metric is if the risk of the fund under evaluation had identical risk to the index. And what I would argue is that what we know is that publicly traded companies are generally levered in the 30% range, whereas PME firms or private firms are generally levered in the 70% range. So just that increased use of leverage would more than double the risk that a PME private firm is taking in compared to similar public firms that are levered at 30%. So what would make sense in my mind, if you could create a public index that represents similar firms, whether it's in the same industry, whether it's market cap, whether it's value versus growth, but in addition to that, to find a way to lever up that index. So what makes sense in my mind is that if you know what the cost of corporate debt is, and you know that this index was levered at 30%, and you know that the fund under valuation was levered at 60 or 70%, you could then model that same index levered to a similar modeled to the amount of leverage employed by the fund under valuation, and then perform a PME index on it.
And
The
how
problem
common
that you run into,
have people started to do that? Is that going to become more common to make these adjustments, this kind of adjustment? Go ahead, please.
nobody has done it. And if I can draw on my experience in the private real estate industry, I worked together with Professor Joe Pagliari at the University of Chicago to compare the aggregate risk-adjusted returns of 3 different types of funds, core, value add, and opportunistic. And what we did is we took the core funds, which are usually levered in the 20% range, and we used a model that said, all right, well, what if we applied more financial leverage to this? And if we levered up the equity until the equity had a volatility that was equal to the index of value add funds, and then we levered up even more to get it to the volatility of opportunistic funds. And at that point, you're comparing on a risk parity basis, at which point then you can look at the difference in nominal returns, and that's going to be your alpha. So to answer your question, is anybody doing this? The answer is Joe and I did it in the private real estate industry. But here's the problem I'd say it's not even a problem. It's if you really apply this sort of, I'd say, quantitative and financial rigor, what you may find is your returns are not nearly as good as you thought you were getting. You're not getting alpha. What you're getting is a large beta. So even if you have a higher nominal performance, so much of that is attributed to the fact that you're taking a lot more systemic risk, in which case, the alphas we ended up coming up with about -3% a year for 18 years. And that made, there's not a lot of people who really like to hear that, especially the managers, and even the investors who, they see this and they say, boy, that makes us look pretty bad. But, when you take what I would consider the principles of finance laid out in, sort of the cornerstones of finance, saying investors should be looking for risk adjusted returns, and you sort of, translate this into a quantitative way to look at it, it certainly didn't make private real estate look too great. Now, that being said, so much of that difference in alpha, those negative alphas, can be attributed to the fee structures that are charged, which are, very similar to more general PE, which is, maybe a 20% over an 8% return, something like that, where you have a hurdle and then you split over that. But what we found is that it's that fee in the way it's calculated. And that's, a lot of people that sort of fits in their head, anything over an 8 is alpha. And that's not the case for, that's not what financial would tell you.
Yeah.
So in my mind, none of these problems are insurmountable if in terms of the investor. It's just investors need to start thinking alpha instead of IRR,
Okay.
and pay fees that are commensurate with the alpha created, as opposed to above some sort of arbitrary, benchmark hurdle.
Okay, great. Well, I think we'll look forward to your paper on the private equity sector now that now that you've done that paper on the real estate sector. So this is my cue to move on to. Let's talk a bit more let's explore a bit more about the fiduciary duty of trustees. So I appreciate this is obviously the definition is a US one, but I think it's very applicable in terms of its general concepts to the global audience. So perhaps you could explain to us what is the fiduciary duty of trustees, in pension funds and other types of investors, and how you see them falling down.
Sure, and what I would say, certainly I'm going to be, actually quoting from the Uniform Prudent Investors Act here in the U.S. But if you look at an organization sort of such as the CFA Institute, that's very much an international organization, and they set their standards based upon, certainly it's very similar to this, and I think the concept of a fiduciary duty is very similar around the world, and it reflects what I consider a modern understanding of finance. So if we go to the Uniform Prudent Investors Act, basically at the beginning of it says the trade-off in all investing between risk and return is identified as a fiduciary central consideration. So it's not about nominal returns, it's about risk-adjusted returns. And some people may have an opinion, our clients just want nominal returns. And if you're acting as a fiduciary, you don't get to make that judgment. You are subject, certainly in the US, to the Uniform Prudent Investors Act, whether you know it or not. And to take that a step further, talking about the Uniform Prudent Investors Act, also quoted from that, it says, these changes have occurred under the influence of large and broadly accepted body of empirical and theoretical knowledge about the behavior of capital markets, often described as modern portfolio theory. So again, getting back to what is it that fiduciaries are legally required to do. They don't get to make their own rules of what they think they can do. They are subject to this codified, if you want to hear a lot of detail about it, go read it, the Uniform Prudent Investors Act.
So what you're saying is that
it'll give you a lot of detail.
Yeah. So you're saying that the duty of the fiduciary is on the nominator. On the nominator, I have my return, but my denominator, I have my risk, and that's what I have to look at. And you're saying there's a whole scale total ignoring of the denominator, of the risk factor, and just concentrating on the nominal return. Because is that a choice, or is that a lack of competence, or what could be some of the reasons for that?
Well, and you said I'm saying, and I would just put this out there as a question for anyone who's seeing this. If fiduciaries use IRR, return multiples, and vintage year percentiles, none of which has a concept of risk, how is it possible that they're fulfilling their legal duty as fiduciaries when the metrics they use to measure performance don't consider risk? So that's my thinking. So everyone would have to make their own judgment for themselves, but that's sort of my way of thinking it. Um, uh, you talked about Ludwig Philippou of Oxford, and from his paper, this is a quote. He said, "The use of such an absurd measure of performance as IRR may seem surprising in an SEC filing, but is standard practice. The same is true for many private documents that are for sophisticated investors only. This puzzle becomes easier to understand after looking at the widely used GIPS standard that the CFA Institute maintains." So it is. So while certainly my reading of the fiduciary duty would lead me to believe that IRR is not appropriate for use as fiduciary work, GIPS seems to think it is. And like I said, this is the disconnect in my head of how can you be acting as a fiduciary if you're using metrics that don't even consider risk. And you asked, why is this? Well, first of all, thinking of risk in itself is a very abstract concept, right? So if you take statistics as a whole and think about, all right, how do we make decisions in an uncertain environment? We don't know what stock returns are going to be in the future, but maybe we can think about in terms of a statistical distribution. Frankly, taking that step of making decisions, say knowing what's not knowable, is a very abstract idea, and I think it may not resonate with some people. So it's a combination of that, and then also just industry practice, and perhaps, as you said, that it's not surprising that all the managers out there don't talk about risk, or they certainly don't want to draw attention to it, especially when we know that these PE funds are using leverage in the 70% range, and traded companies are using 30% range, and we can precisely measure if the assets have similar risk. We can precisely measure how much that increase in leverage adds to equity risk, or at least what the beta risk would be of the PE firm and compared to similarly publicly traded firms if assets are the same, but the only difference is 70% leverage versus 30%.
But would you say, I mean, some of these boards of trustees, maybe they, I mean, I imagine some of the individuals on these boards are not all totally financially sophisticated, because there may be some sort of, there may be political appointees or kind of good old boys or whatever it is. But I would imagine that they should start making more use of the expertise to help them, assess these kinds of risk levels, rather than just do something as simplistic as a return. I think I was struck by the CalPERS announcement of a kind of a idea that we're going to go for 7% with leverage, but it wasn't really very clear, the announcement, what it really meant to anybody. And I thought they might be more sophisticated. But I'm thinking, if CalPERS is like that, imagine some guy in the backwaters of Kentucky. So what's with that, would you say?
Well, and like I said, I would these concepts, I would say modern portfolio theory sort of thoughts on finance, are abstract. And I think what you see, it's sort of natural human nature to say, hey, we made returns. We made a 12% return. Boy, we did good. Forget about risk. Or I've also heard it said this way is, our investors, they don't want risk adjusted returns. They just want returns. So if you get a 12 or 15% return in a certainly over the last, 8 or 10 years since the GFC, when asset prices have gone up quite dramatically, it was, you just put a lot more leverage on something, you look like you're magic. But the problem that you run into is that when an asset drawdown comes during, like, for instance, the great financial crisis, instead of being down, 30%, you're down 80%. And talking about CalPERS for their real estate portfolio, during the great financial crisis, their real estate portfolio had a peak to trough drawdown of around 70%. And, what fiduciaries need to ask themselves, if you're working on behalf of a pension, do we have a risk tolerance to lose 50, 60, 70% of our money every 10, 15, 20 years? And it certainly there's uncertainty about that, of how much risk you're taking and how often you think you may lose and how much, and it's certainly a judgment call to make. But it's something that I would think fiduciaries should think through. And then in addition to that, then they need to think, how much return are we getting per unit of risk? And that is even in the financial field, is I think there's a dearth of people who really truly understand it.
Yeah, no, I think you're right, because once it gets a bit more statistical and mathematical, it is quite challenging. I mean, I did, engineering for my undergraduate, and I did my stats, my MBA, but still, you really have to sit there and kind of go through it and to really sort of get a grasp on it. And I guess the third topic we wanted to cover was moving on from fiduciary was to actually how do you assess risk, for specific security. And I think maybe we could kick off with thinking about the Sharpe ratio, as a measure. I guess that's an improvement from just going with a nominal return. At least it's the right step. So maybe you could just outline how the Sharpe ratio works, and what are its implicit assumptions, and what are the deficiencies, and what could be done to make it even better in terms of the measuring this holy grail, which is the risk-adjusted return, properly risk-adjusted, I think, which what we're trying to get to.
Sure, and hopefully during this discussion, I think what you'll see is that there's not one exact. This is the silver bullet that makes everything work right. This is a way to do it. But I think instead, what you see is you have some ways that are thought out better than others, and you'll see some estimates of risk-adjusted return. You can say, boy, that is really well thought out, and the assumptions were laid out. And I think it's also reasonable to say, hey, listen, we think this is a range of what we think the alpha is, because we made a range of what the beta is. So to really do some sensitivity to it also. But getting back to the question of what is a Sharpe ratio, if you invested in, let's say, a security, and the returns are normally distributed, and this is, you talk about like a bell curve, and you think, okay, we think we're going to make a 8% return, but could we lose money next year? Absolutely. And you sort of put some numbers to that. And this is sort of, I would say, the building block of thinking about risk. But when you look into the details of it, it gets much more challenging. For instance, there's several assumptions that go into using volatility as a proxy for risk. The first being that returns are normally distributed, and for traded equity, it's not a bad assumption. You see some downward skewness in the distribution, but it's a reasonable guess, and I think that's why they teach it in business school. The next assumption is that every measurement is independent of the previous. So, for instance, you don't have trends, everything going up, everything going down, for years at a time. And for traded markets, that's actually a pretty good assumption. Now, if we compare that to private markets, you see something very different. You'll see something they generally refer to as return smoothing, which means that you're not getting the independent measurements of value that you get in traded markets. In addition, what you see is a much larger skew to the downside for for instance, when the great financial crisis, if you sort of look at a histogram of returns, you see a real outlier to the downside. And so if you use volatility as a proxy for risk, for instance, for private funds, it's going to make private funds look much better. It's going to make their alpha look much better because you have significantly undermeasured beta. Now there are
so just to put it into simple terms, what you're saying is that the calculation of the Sharpe ratio, or the equivalence, implicitly assumes that the returns on the security are normally distributed. However, you're saying that which is a good approximation to public securities. But in the case of private equity, the returns are not normally distributed. There's some serious skews, towards another distribution. And the effect of that, coincidentally and luckily for the fund managers, seems to be that if you apply assume it's a normal distribution, it favors them. Is that the effect of the methodology?
Correct, and adding in the fact that the lack of independence, or statistically they generally refer to that as autocorrelation. But yes, that's exactly right. And there's analytical ways that you can go and adjust for these sorts of things. But again, to the extent that you undermeasure the risk that one is taking, it makes the risk-adjusted returns look better.
Okay, so how are there methods to are there sort of broad generalized methods you can use, like an improved Sharpe's ratio, or something you could adapt specifically for private equity? Or is it more a question that you have to look at each case or each data set on a case-by-case basis and do ad hoc adjustments? Well, what's the kind of a best professional practice to get to the true figure, let's say?
Well, there's a lot of people doing a lot of different things. Like I said, I mean, is IRR well accepted? Well, LPs are willing to pay for above like an IRR hurdle. So that's sort of their implicit way of saying, yes, we think this is a reasonable way to measure performance, which again, it has no concept of either a market type based benchmark or adjusting for risk. So I would say in terms of the industry adopting things like this, there are certainly professors that have, suggested things, and but my experience is they're just not really well adopted. And one of the reasons, the reason why people like IRR, it's easy to calculate. Here's a series of cash flows. You plug it into Excel. You just X IRR. There's your return. It's easy, and it just doesn't do what modern fiduciaries are supposed to be doing.
Yeah, well, that's one thing that struck me. Yes, one thing that struck me a lot was, for example, if we take the example of when Ludo Filippo put out his paper, you would have imagined that the industry would have, welcomed the advancement of knowledge. Someone like ILPA or, IPEV or Invest Europe, the big associations of private equity, or others would have said, oh, this is great, we need to look at it. Instead, there was all this pushback, and virtually, I think Filippo's in witness protection right now, as far as I can understand it. So,
well, I think I have a. So again, being a little bit more on the private real estate side, the paper that Joe and I wrote, we estimated that LPs are paying about $7.5 billion more in fees than were economically warranted. That was in 2017. I'm sure it went up in 2018 and 19. And there's a lot of people who make really nice livings off of those fees. So they're going to do anything that they can to put out a counter argument. Similarly, let's say you're working for a pension fund and you are running, in this case, the real estate portfolio, and someone comes out with a report that says, hey, listen, these funds are taking a lot more risk than you would think, and you're not really, maybe you have a higher nominal return than core funds, but you're not getting the additional returns that is commensurate with the additional risk that you're taking. So someone who's working in a position like that wouldn't be real happy to hear this either. So, I think you're seeing the exact same thing in the private real estate industry as you are in the private equity industry. And, if we go back 20 years, you've just seen such a run up in, EBITDA multiples for buyout companies. And that means assets returns have done great, of course, with the, slight interruption by the GFC. So anyone who took more leverage would have done on average much better. It's sort of putting this logical overlay onto it, saying, yeah, okay, you did get better returns, but what if you had just bought, for instance, similar public companies and used some margin debt and synthetically levered up to 75%? And that's what essentially there's a paper written by a guy at Harvard, whose name I have right here. His name is Eric Stafford. And that's essentially what he says. He said, listen, you could have replicated PE just by buying similar publicly traded companies and levering them up, and frankly, just not looking at the mark to markets, because for PE, so for instance, this spring when asset prices dropped significantly, you didn't see that drop in PE valuations. And for one, in defense of PE investors, it's, it's tough to know okay, you have last month this company was worth, something, now it's worth 30% less. What are you going to go find some comps for other companies that sold when the market drops that much in 2 months? You're not going to get it, which is fine. It's an honest thing. But it's just knowing that if you see that drop in the public markets and you have that price discovery, you're going to be a lot more aware of the risk that you're taking than if you're invested in a similar company, but it's private instead of public. And I think that's what scares people away, but it obfuscates the risks that they're taking. Are they taking the same amount of risk? Yes, they are. They just can't see it. And I think for a lot of investors, it just makes them feel better.
Yeah, and I think though, the picture I'm getting from this discussion is that you have people, thinkers, analysts, academics who are bringing attention to this and doing work on it, but the industry itself has a vested interest, not really in engaging in trying to bring this knowledge to bear on better decisions, because it's somehow kind of rocking the boat or rocking the status quo. And so my, I think certainly from my experience, just obtaining this information, it's kind of the odd report here and there, but it's really not a body of knowledge that's gaining any traction. Would that be your experience? On your side of the Atlantic?
Well, I mean, getting back to Ludo's work, I mean, he estimates that there's been about $230 billion in fees paid in promote and performance fees paid to, PE managers, and they got pretty much the same return as similar traded companies. So that $230 billion, like I said, there's a lot of people who've gotten real wealthy off of that, and they're going to do anything in their power to sort of discredit this line of research that suggests that they may not be the panacea that everyone thinks they are. But like I said, you've had these valuations that have gone up dramatically over the last 20 years, and I would say that the best way to tell how much risk you're taking is to have asset prices drop significantly and stay there for a while and see what the drawdowns of relative funds are. And I could draw a parallel to the private real estate industry, where you had this tremendous drawdown in commercial real estate prices in the US. And frankly, before you had that, it was the sort of the signal to the noise of how to bifurcate returns into alpha and beta. It was a bit challenging for private funds, but after that, when you have a significant drop in valuations, it makes it much easier to separate the relative risk each were taking from each other and figure out how much of the return was attributed to alpha and beta. And if valuation multiples drop from EBITDA from 11 back to 7 in a short amount of time, in several years, I imagine you get much better numbers, a much better estimate of the beta or the relative risk they're taking. But at that point, it would be really ugly for PE investors, and that's exactly what we saw in the commercial real estate industry, where the more highly levered, the more risky funds drew down significantly more than the core funds. But even with that, like I said, it's sort of like a natural science experiment. A lot of people don't connect with these concepts of bifurcating risk into alpha and beta, and then when you do have an asset, price drawdown, everyone seems very surprised. Oh, we didn't know we were taking this much risk. And I see parallels. There's no shortage of supposedly sophisticated institutional investors out there who were exposed to a short vol factor going into the beginning of this year, and then you have these large institutions that lost just enormous amounts of money because they just didn't even know what they were investing in, or didn't even know what the risk factors were, or realize that when like a short vol type factor blows up, it does it when markets, significantly fall off, and it does it in a much more dramatic way. So, it seems like, people get very serious about risk after there's an asset drawdown, but it's thinking about it all the time that investors should be really thinking about. What is your risk tolerance? How much risk are you taking, and are you being adequately compensated for it?
No, I think that's right, because certainly as a mid cap fund manager, I mean, I often find myself thinking about the risks of the different companies in my portfolio and trying to manage those on a kind of day-to-day basis. But I think it's true, as you say, as long as everything's going okay, people don't think about it too much. So I think one of the other things is that, given that it's so hard to measure these returns, it must be very difficult to try and assess actual fund managers. And I think, how do you figure out who's really a top quartile fund manager? Is it the fund manager who is got the highest nominal return, or is it the fund manager who's got the best risk-adjusted return? Because you might be rewarding the hare, and in fact, the hare's going to crash and burn soon, and the tortoise should be in the top quartile. So I'm simplifying it as calling them hare and a tortoise, but would that be a fair comment to make about the assessment of fund managers? Because as fund managers, we're all obsessed about being top quartile. Obviously, you got a conference. You'll never meet a guy who says I'm a bottom quartile guy. They're all top quartile.
Yeah, it's funny how that works. Yeah, it's amazing. No one's ever bottom quartile. No, you're exactly right, and I think that's part of you have this whole sort of people studying behavioral finance and how people make poor decisions. And again, up until this spring, we had a 8-year run of very strong asset returns. So anyone who used more leverage would have gotten higher nominal returns. Now, does that mean what that also means? If you selected someone who got the higher nominal returns, who was taking more risk, you're also likely going to draw down more when this spring when asset prices have drawn down. So that's really why you're supposed to be thinking about return per unit of risk. But getting back to your question about persistence, so there's two things you need to think about. The first is, what is it your investors are looking for? Now, alpha is what investors should be looking for, but at least using a PME is a step in the right direction, because you're incorporating a market based benchmark into it. And there's a study that was put out, I guess, a couple of years ago, and I can pull it up right here, the name of it. I believe it was have private funds, has persistence persisted in private funds? And what they did is they took a large data set of Burgess data, and they used a PME methodology, and they said, okay, for all of these managers out there, we're going to take previous funds, we're going to figure out what the previous fund's quartile was in terms of PME, and we're then going to compare this to how the subsequent fund did in terms of PME quartile.
So just to interrupt. So their methodology, instead of taking the nominal returns, they used the PME. So in other words, the risk adjusted returns when they did the analysis of the quartiles. Is that right?
Well, remember, a PME does not adjust for risk, but the only way it would be alpha is if the public market had similar risk as the fund under evaluation. And we know that's, I think we can be quite certain that the private funds, if they're using 70% leverage, are probably taking more risk than the similar public funds. Now, how to estimate what that is, I mean, that's a real challenge. But, so at least for the PME in itself, it's not necessarily a risk-adjusted return, but it does incorporate market returns. Okay. So what they did is they said, okay, we have this whole list of funds here. We're going to run a PME on each one of them. And then for each vintage year, we're going to look at what quartile they were, and then we're going to compare them to the subsequent funds run by the same manager and see what quartile those funds were, and see if there's a relationship between the previous fund's quartile and the subsequent fund's quartile. And what they find is there was hardly any relationship at all, except for at the very low performing funds. So to your point, asking about persistence in private equity fund returns, there's very little in buyout funds. Now, it's different for VC funds, and in that same report, that same paper, they showed that there was persistence in VC performance quartiles, but not for buyout PE.
And what about for other types of PE, like, for example, growth, which is something in between venture and buyouts or mezzanine? Did they look at that as well, or was it just pretty much venture and buyouts? Because the difference being, obviously in America, in the US, people talk about buyouts and venture. In Europe, we talk about, we tend to classify it as buyouts, growth, venture, and mezzanine, sort of 4 subclasses, because the growth sort of falls in between the cracks a little bit. So what did they look at it in more detail than that?
No, those were so they used Burgess data, and that's how those are the buckets that Burgess. That's how Burgess tracked it, and they didn't break it out any more than that. And there may be research on that out there that I'm not aware of. What I would also draw attention to is a paper that Joe and I did. The one that we published in 2019 look at the different fund types in aggregate. And what we've done is we've applied to private equity research and consortium to see if we can get access to the Burgess data to introduce a methodology that we would suggest is I would say it's the best reasoned way to think about the alpha created by individual real estate funds, closed-end real estate funds, which is a combination of the methodology we used in our previous paper and the direct alpha, PME, but instead of using a public market, you would use a levered core index. And we would like to do the same thing there, where we look at, is there persistence by manager? Because right now, we just don't know. No one's ever looked into it. And it seems like something that's important to look into. So what our paper showed last time is that an aggregate non-core funds had generated large and persistent negative alphas compared to core funds, basically meaning investors would have gotten a much better return per unit of risk by either levering up core funds or investing in funds that are generally called core plus, which, if defined as core funds with more leverage, they would have been much better off. Now, if someone says, hey, listen, we can consistently pick winners, if you can do that, then that would, then the average doesn't matter as much. And so what we're going to go look at is to say, can you use, historical performance metrics and use those as a predictive metrics of subsequent funds? And like I said, I draw a parallel to this study on PE in general, showing that the relationship was extremely weak. And like I said, we just don't know. So that's the reason why we want to go and do this investigation.
Well, I think it would be very important because, one of the main premises in private equity is this kind of top quartile idea that, the fund manager in a top quartile has this superior skill set or experience or whatever it is that allows him or her to replicate it in future funds. And that's kind of like one of the big selling points that you use in fundraising. But if the evidence suggests that it's not that, and it's more kind of a part of the cycle, or whether your specific skill set has no influence, that's going to lead to a completely different way of thinking about private equity, because so much of the thinking about private equity fund managers is based upon this top quartile. I mean, obviously, there's probably some massaging to the numbers. I think I'm quoting from a book by Josh Lerner, who said that the way they classify fund managers is a bit like a mediocre college, where the average grade is A minus. So again, you never meet the bottom quartile guy. Maybe he didn't have the money to attend the conference, but so clearly, this paper would shed a huge new light on that, because it's the way I see it is it's in everybody's interest, particularly the ultimate beneficiaries of pension funds, the guys of the 401ks, to be invested in a good fund manager, and there's got to be a way to figure out who a good fund manager is, and whether there is a persistence or whether it is just a kind of a luck from one fund to the next, which I find hard to believe from an intuitive point of view. So it would really be good to get the scientific study to really understand where the reality lies, because at the moment it's a lot of hearsay, it's a lot of kind of urban legend. There's a kind of a received wisdom that if you're top quartile, you sort of stay there unless you're unlucky because you've got these skills. So it'd be really interesting to see this paper, and I'm definitely very keen to hear your results of your research, because in a way I'm a bit scared of it as a PE fund manager, but at least we'll get to the bottom of it.
Well, and what I can tell you, Gavin, you said earlier that you came from an engineering background, and I think I suffer from a similar ailment where, in my mind, if you can't measure it, it's just someone's opinion. So that's, you'd hear these sort of, like you said, urban legends, and I said, well, what data do you have to back it up? If that's the case, someone should be able to show you some numbers. And then when someone said, I don't know, we just feel like good managers should continue to be good managers. So that's sort of the thought process that I bring to this. And what I would say, it is very important to have successful, well-capitalized private equity firms out there. I have absolutely nothing against private equity. And like I said, in real estate, what we found is that there's nothing that can't be fixed, or not can't be fixed. So what we found is that there's large negative alpha for non-core funds compared to core funds. There's nothing that a change in fee and compensation and fees to reflect the alpha generated as opposed to the difference in nominal performance. So, I don't want to come across as someone saying I'm anti-PE at all. That is not the case at all. What I want to get across is that investors, LPs, pension funds need to think about the value that they're getting for the fees that they pay, and are they getting value that's similar to, for instance, let's say an investable benchmark. So like I said, I have nothing against private equity. And as a matter of fact, I would point this out. I saw, for real estate, Norges Bank, they're largest sovereign wealth fund in the world. They're actually investing in private real estate directly in a way that I would say it looks remarkably similar to what Joe and I suggested investors should be doing our paper, essentially what they're doing is they're buying core assets in high barrier to entry markets and working with some of the best asset managers in the world, and they've negotiated a fixed low fee. They're paying 30 basis points a year for asset management fee compared to 100 basis points for core funds and 300 for value add funds historically and 400 for opportunistic funds. So I think that they are, if you want to look at, in my mind, of what they're doing in private investing, they're doing exactly what the data suggests investors should have been doing historically.
Yeah, I think what you're also describing is similar to what some of the Canadians are doing, right? Someone like Ontario Teachers, where they've built these pretty good teams who co-invest more and more alongside the GPs and even have their own direct investment group. I remember having an argument with somebody at conference. He was saying, well, you can't compare the skill set to KKR. I said, come on, don't tell me that a 33-year-old working for Ontario Teachers or Alberta Pension Fund, who's earning a tenth of the KKR guy, is 10 times worse than him. I just don't buy that. So perhaps that could be the future. Sort of vertical integration on the part of the pension funds. And there was also one idea. I remember I had another discussion at a conference, and I was saying, look, the standard private equity model is you get a 2% management fee, or maybe less if it's a bigger fund. You've got a hurdle rate of say 8% and a 20% carry. What about changing it, making a simple change? Instead of a 2% management fee, you just have to submit a budget for rent and salaries for the operating costs. You increase the hurdle rate to 12%, which is more like the cost of equity, and you get a bigger carry of say 30%. What would you think? Do you think something like that might align the interest better? I'm sure that people wouldn't like it, but maybe it's a fairer system.
Well, I understand you want to incent managers to, to focus on what they're doing. What I've seen, certainly in the private real estate industry, is that the core funds, which have a flat fee, have generated alpha significantly higher than non-core funds. Now, and you want to incent managers, but here's a good way to incentive. Okay, let's say take Norges Bank, right? For an example, if they give you $100 million and you do well with it, and you're getting paid a flat fee, whatever you're paying, I think they are averaging around 30, and they say, boy, we really like what you're doing, Gavin. We think we're going to give you another $500 million. It seems to me that creates a pretty good incentive itself, because when you get into thinking about measuring the alpha created and, okay, how are we going to benchmark, and what's a market-based benchmark, and how do we adjust for risk and all this other stuff, and you go down to this mathematical sort of rabbit hole, I would say if you have a pension fund and they have money to invest, if they like what you're doing, they'll probably allocate more to you. Does the incentive get much better if you like I said, like you were talking about, doing something that's much more quantitatively advanced and think about alpha, things like that. Do you need to do that to incent them, or just the fact that, hey, listen, if things go better, we have this large pension fund who's a client, they'll just give us more money in the future? And
yeah,
for
good point.
For real estate, my thought is the marginal cost to manage a property is a heck of a lot less than the average cost. So for instance, if you have an asset management team that's spread out among the country, all over the country with different asset classes, they're already managing, $30-40 billion worth of assets, managing another $1 billion worth of assets, I would imagine the marginal cost of that is significantly lower. And if you could charge a fee that is similar to your all-in cost, you're going to see a lot of that going to your bottom line. So like I said, there's economists that spend a lot of time thinking about how to align interest and things like that. But my experience in the private real estate industry is that, the best performing funds have been the ones that have had a flat fee. So, and by the way, I'm all for paying for performance, for alpha, as long as it's for that. And I certainly have no problem with people making a nice living, people who do innovative things, people who are creative and are really good managers. But I think it does get challenging as we sort of talked about here to think about how to benchmark and how to do this. Whereas just, if someone just says, hey, we're a large institution, if we like what you're doing, we'll just give you some more money.
Fascinating. Okay, well, I think we're sort of coming to the end of our scheduled hour. I did have one question I was asked to pass on, which was about how do you, so the question, I'll just paraphrase the question I got, which was, how does the type of research and work compare between an academic who's a full-time academic who's looking at this thing and someone like yourself who's let's say a sophisticated financial analysis working in the industry? What are the different relative strengths and weaknesses, and obviously you're working with academics, but the question was, what are the differences between the two?
Well, when you use the term academics, sometimes I sort of interpret it as saying, oh, it's just someone who's good at math, right? So if you're like had an aerospace engineer or someone just designed a plane and say, oh, he's an academic because he knows a lot of math. Like, no, that's what you need to do the job to design a plane. Um, uh, so if someone who's a practitioner uses a lot of math, or uses, basically looks to the, I call it, the principles of finance, the analytical tools that you have, the quantitative tools. If you use those, some people said, oh, it's just, it's very, that's very academic. And I said, no, it's not academic. These are the tools that you need to do the job. Certainly academics are, theoretically in it to develop more knowledge, to figure out what's happening. And if, they're compensated by their university, then they're not going to get a bonus for saying, oh, PE is good or PE is bad. I think they're, looking at balance, sort of a balance is, hey, listen, we don't care if they're good or bad or not. We want to get to the bottom of this and figure out how much value they've created. Now, if you're working for, let's say you're working for a pension fund and someone says, all right, we want you to come in and evaluate how our private equity fund has performed, and if you show up and say, well, what we find is that you've gotten returns that are pretty similar to public markets, you've just taken a heck of a lot more risk and paid a ton in fees, that's not going to go real well with the people who are the current PE managers. So it's almost like, here's your answer, find a way to back into it. But then when people like Ludo start looking at it and they say, no, here's the data here, and this is, and actually what you see in his research, he said nothing about relative risk between the two, because relative risk, how to measure that, is there's not an accepted orthodoxy to do that. And certainly I can point out some things that are observable, like the difference in leverage, but he didn't point out anything that had to do with it. He just said, if you look at the raw data, the nominal returns, they're pretty much the same. You've just paid PE managers $230 billion in fees. And I think he's just, trying to convey these thoughts that are relatively simple. He doesn't talk about alpha or beta or small cap, large cap, or any of that stuff. He just says the returns have been similar. You paid a gigantic amount in fees. But you can understand, if you're compensated by a PE manager, you know what the answer needs to be. If you're compensated by a PE consultant, you know what the answer needs to be. Whereas if you're an academic, you can say the answer is going to be what the answer is going to be. The answer is going to be what the data tells us.
Yeah. So yeah, great space for somebody who's more objective. Okay, Mitch. Well, it's been a really fascinating discussion. I thank you very much for your time, and I wish you the best of luck with your hurricane, your upcoming hurricane.
Yeah, it's a great time to be in South Carolina in the U.S. We have a pandemic and a hurricane about to hit. So it's maybe an asteroid is coming next.
All right. Thanks, Mitch.